In this full tutorial, we will explore a price action trading strategy, no indicators needed, and learn how to read the raw price chart to make trading decisions. Price action trading revolves around the belief that price movement is the ultimate reflection of all available information in the market. Instead of relying on lagging technical indicators, we'll focus on the most reliable indicator there is, price itself. By the end of this 30-minute guide, you'll understand how to identify market structure, draw key support and resistance levels, recognize candlestick patterns, and execute trades using pure price action. We will also illustrate each concept with clear TradingView style charts on a light background for better understanding. Whether you trade Forex, stocks, or crypto, mastering price action can help you make better informed trading decisions by focusing on what the market is actually doing in real time without any distracting overlays. Price action trading is a method of analysis that uses a naked chart, stripped of indicators, and relies solely on price movement and chart structure to make decisions. In other words, every candlestick, high, low, open, and close, is the data we analyze. Price action traders believe that price is the only truly leading indicator because everything you need to know is reflected directly in the price itself. Instead of lagging signals, you get immediate insight into market sentiment. This approach means observing how price behaves at certain levels, how trends form, and how patterns like candlesticks or chart formations signal the next move. It's a minimalist style of trading, typically just candlestick charts on a clean background, which many find gives greater clarity. Keep in mind, trading without indicators doesn't guarantee success. It's simply a preference for those who want a clearer, less cluttered view of the market. The skill lies in learning to interpret the story that price is telling on its own. Trading without traditional technical indicators, like moving averages, oscillators, etc., has several advantages. First, indicators are all derived from price, so they tend to lag behind actual market moves. In contrast, raw price action is as real-time as it gets, allowing you to react quicker to changes. Many traders also find that indicators can overcomplicate or even distract from what's important, the price. As veteran price action traders often say, there's no better indicator than raw price action. It has the most direct relationship with market participants and is the least lagging of the bunch. By ditching the dozens of squiggly lines, you force yourself to focus on market structure, momentum, and sentiment gleaned from price alone. Everything from major bank trades to economic news ultimately shows up in the price's movement. Thus, price action is the purest form of technical analysis, cutting out the middleman, indicators, and giving you a clear view of supply and demand dynamics. Remember, this doesn't mean indicators are wrong or useless. Many traders use a combination, but price action traders prefer to start with a clean chart and only add minimal tools if absolutely necessary. Ultimately, all technical signals come from price, so learning to read price action can sharpen any trader's skill set. One of the first key concepts in price action trading is market structure, specifically identifying whether the market is trending, uptrend or downtrend, or ranging sideways. We look at how price swings form on the chart. Market structure example: an uptrend making higher highs, HH, and higher lows, HL, followed by a downtrend with lower highs, LH, and lower lows, LL. Trends shift when the sequence of highs-lows breaks. Uptrend. An uptrend is defined by a sequence of higher highs, HH, and higher lows, HL. This means each significant peak is higher than the last, and each pullback low is higher than the previous low. It shows demand outweighs supply. Buyers are in control. In an uptrend, traders look to buy, go long, on dips, expecting the price to continue rising. For example, in the chart above, notice how the uptrend on the left consistently marches to higher price levels on each wave up, and the lows on pullbacks never undercut the prior lows. Classic bullish structure. Downtrend. A downtrend, conversely, is a series of lower highs, LH, and lower lows, LL. Each rally fails below the height of the previous one, and each sell-off makes a deeper low. This signals supply, selling, is dominant. In a downtrend, traders favor selling, shorting, on rallies, anticipating further declines. In the chart above, once the trend reverses, around the middle marked trend reversal, you can see prices start making lower highs and lower lows. A clear sign that sellers have taken control of the market direction. Trend transitions. A trend change often occurs when a prior support level breaks in an uptrend, or a resistance level breaks in a downtrend, leading to a shift in the sequence of highs, lows. In our example, the vertical dashed line marks a point where an uptrend peaked and then price made a lower low for the first time, signaling a potential downtrend onset. Price action traders watch for these clues, such as a higher low failing or a lower high forming, to catch early signs of a reversal in market structure. Ranges. Not all markets trend all the time. Sometimes price moves sideways in a range, oscillating between a horizontal support and resistance. In a range-bound market, neither buyers nor sellers have a lasting edge. The price will bounce between support and resistance without a clear directional bias. Price action traders will either avoid ranging markets due to unpredictability or employ range-specific strategies, buy low at support, sell high at resistance. However, it's crucial to recognize when the market is flat. Trend-following tactics won't work well in those conditions. Understanding market structure is foundational because it sets the context for all other price action techniques. Always identify whether you're in an uptrend, downtrend, or range first. It will guide you on whether to look for buy setups, sell setups, or stay aside. As the saying goes, trade with the trend. You dramatically improve odds by aligning with the prevailing momentum rather than fighting it. Another core concept of price action trading is identifying support and resistance levels on the chart. These are horizontal price levels or zones where the market has shown a tendency to stop and reverse due to concentrated buying or selling pressure. Key support and resistance on a price chart. Notice how price bounces off support, blue line around $100, and reverses near resistance, purple line around 120. When support at $100 eventually breaks, it triggers a sharp decline. Support. A support level is like a price floor that the market has trouble falling below. It's a level where buying interest is strong enough to overcome selling pressure, causing dips to bounce. Traders find support by looking for prices where a market repeatedly stops falling and turns back up. For example, if a stock or currency pair has bounced off $50 several times in the past, $50 is a support level. Buyers consistently step in there. In our chart above, around the $100 price zone, blue dashed line, you can see how initially the market found support. The down moves paused and reversed upwards near that area. Support often forms at previous swing lows or psychological round numbers. Resistance. Resistance is the opposite, a price ceiling that the market struggles to break above. It's where selling pressure tends to overwhelm buying, causing rallies to stall or reverse downward. Resistance levels are found by spotting where price rallies have repeatedly failed. For instance, turning down from $210 multiple times would make $210 a resistance. In the chart, the area around $120 acted as resistance, purple dashed line. The uptrend peaked there, and later attempts to rise back toward $120 were met with selling. Previous swing highs often become resistance levels. Role reversal. A noteworthy phenomenon in price action is that once a support level is broken, it can turn into a future resistance level, and vice versa. This happens because traders' psychology flips. A price floor that fails becomes a ceiling as traders who bought at support exit at break-even, adding selling pressure, and those who shorted the breakdown defend that level. In our example, the $100 support eventually gave way. Price plunged below it. When price tried to rally back, that same $100 level could now act as resistance from beneath. This is called a support-turned-resistance flip. Similarly, A broken resistance can turn into support on pullbacks. Supply-demand zones. Support and resistance work because of supply and demand imbalances. At support, demand, buy orders, overwhelms supply, pushing price up. At resistance, supply, sell orders, exceeds demand, pushing price down. These levels are often zones rather than exact lines. You might see price slightly overshoot and then reverse. Many traders draw zones or bands to encompass the area of support or resistance. They also pay attention to volume, as high trading volume at a support or resistance gives extra confirmation that the level is significant. Trading with SR. Price action traders use support and resistance for planning trades. Common tactics include buying near support in an uptrend or range, with a stop loss just below the level in case it fails, and selling near resistance in a downtrend or range, with a stop just above it. When combined with candlestick patterns, next section, these levels provide context for high probability entry points. Also, when a level breaks, it can signal a big move. For example, a breakdown below a major support might lead to an accelerated drop, as seen when $100 broke in the chart, since stop-loss orders trigger and new short sellers jump in. In summary, support and resistance are critical price action reference points. Always mark recent significant highs and lows on your chart. They will help you anticipate where the price may stall or turn, where to set targets, and how to place stop losses safely beyond these barriers. With market structure and key levels in mind, the next piece of the puzzle is price action signals, typically given by candlestick patterns. Candlestick charts offer a wealth of information in each candle's shape, and certain patterns are well known to signal shifts in momentum or trend continuations. Let's cover a few of the most important candlestick patterns that price action traders watch. Common candlestick reversal patterns. Left, a bullish hammer, pin bar, with a long lower wick signals a potential upward reversal as buyers absorb selling. Right, a bearish engulfing pattern where a large down candle engulfs the prior up candle, indicating a bearish reversal. Hammer, pin bar. The hammer is a one-candle bullish reversal pattern. It has a small, real body near the top of the candle range and a long, lower wick, tail, with little or no upper wick. This shape looks like a hammer. Body is the head, wick is the handle. A hammer occurs after a decline or at a support level, and it signals that sellers push the price down, long lower shadow. But by the close, buyers had driven it back up near the open. In other words, buyers are starting to overcome sellers. The psychology: aggressive buying stepped in, potentially marking the end of the down move. Hammers are more powerful if the next candle confirms by moving higher. Note: if this pattern occurs after a rally with a long upper wick instead, it's called a shooting star, which is a bearish reversal signal indicating buyers were overwhelmed by sellers near the top. Engulfing pattern. An engulfing pattern is a two-candle reversal signal. It comes in bullish or bearish forms. A bullish engulfing occurs in a downtrend or near support. A down candle, usually red, is followed by a larger up candle, green, that completely engulfs the previous candle's body. This indicates a sharp swing from selling to strong buying. The second candle's buying pressure engulfed the prior selling. A bearish engulfing, shown on the right chart above, is the opposite. In an uptrend or near resistance, a small up candle is followed by a big down candle that engulfs the previous candle's range, signaling that sellers have seized control. Engulfing patterns are powerful because they visually show a sudden and decisive shift in momentum. For example, in the chart, the bearish engulfing pattern had a large red candle wiping out the prior day's gains, a clue that a downward move was likely to follow. Indeed, it kicked off a bearish reversal. Doji. A doji is a candlestick with an almost equal open and close, resulting in a very small body, often just a line, and wicks on either side. A doji represents indecision in the market. Neither buyers nor sellers could secure control. By itself, a doji is neutral, but its context matters. After a strong trend, a doji can warn that momentum is waning, a potential reversal or pause. For instance, a series of dojis or one long-legged doji at a resistance might hint that buyers are exhausted. Always pair a doji with other signals, like a subsequent candle breaking the doji's range or occurrence at a key SR level, for confirmation. Inside bar. An inside bar is a smaller candle that forms completely within the range, high to low, of the previous candle. It signifies a volatility contraction or temporary consolidation. Price action traders often interpret inside bars as potential breakout setups. The market is coiling and could break out in either direction. A common strategy is to trade the break of an inside bar's high or low, effectively riding the next momentum move. If an inside bar occurs at support in an uptrend, breaking its high could trigger the next leg up, continuation. Conversely, at resistance in a downtrend, breaking below an inside bar's low could resume the drop. Other patterns. There are many candlestick patterns, but not all are equally significant. The ones above are some of the most useful. It's worth noting that larger multi-candle patterns or formations also guide price action traders. Reversal patterns such as head and shoulders, double tops, bottoms, or wedges on the chart indicate a trend may be ending. Continuation patterns like flags, pennants, and triangles signal that the trend took a brief pause and is likely to resume. These patterns can span many candles and form clear geometric shapes on the chart. While our focus here is on the candlestick entry triggers, be aware of these bigger pictures. For example, a head and shoulders top is essentially a complex price action story of buyers weakening and sellers taking over, often confirmed by a break of a neckline support. When using candlestick signals, context is key. A hammer is far more meaningful if it occurs right at a known support after a pullback, and an engulfing is most telling at the end of an extended move or at resistance. By combining candlestick patterns with market structure and SR analysis, you gain a confluence of evidence for higher probability trades. In the next section, we will put it all together into a step-by-step strategy. Now that we have the building blocks, trends, levels, and candlestick signals, let's outline a step-by-step price action trading strategy. This strategy focuses on trading in the direction of the prevailing trend, entering on a pullback using a price action confirmation. No indicators needed. We'll break it down into clear steps. 1. Identify the market trend. Start by determining the overall trend on the time frame you're trading. Is the market in an uptrend, downtrend, or range? Use the higher highs, lows versus lower highs, lows method discussed earlier. You want to trade in the direction of a strong trend whenever possible, as that stacks the odds in your favor. If the market is choppy or range-bound, be more cautious. The strategy works best when a clear trend is present. When in doubt, zoom out to a higher time frame to confirm the trend. For example, if you see on the 1-hour chart that price has been making higher lows and higher highs consistently, you've got a bullish trend. You'll be looking for buy opportunities. 2. Mark key. Support, resistance levels. Once you know the trend, identify the nearest important support and resistance levels. In an uptrend, focus on support, especially the recent swing lows or key Fibonacci retracement zones if you use them, as potential entry zones for buys. In a downtrend, focus on resistance, recent swing highs, for sell entries. Also mark any major horizontal level that price is approaching. Even in a trend, an upcoming huge resistance could stall an uptrend, for instance. These levels will act as decision points. You expect price might react, bounce, or reverse there. By plotting them in advance, you'll be prepared to act or avoid false signals. For example, in an uptrend on EUR/USD, if you spot a strong support around 1,000 from a previous low or big round number, that's a location you might consider buying if price pulls back to it. 3. Wait for a pullback into the value zone. In a trending market, you typically don't want to chase price after it's already moved far. Instead, Wait for a pullback, retracement, toward a support in an uptrend, or resistance in a downtrend level. This is often called the value zone, where you can enter at a better price before the next swing in trend direction. Pullbacks occur because even in strong trends, price moves in waves, not straight lines. A healthy uptrend will have periodic dips, which are opportunities to join the trend at a relative discount. For instance, if gold has been trending up and just hit $1,800 before dipping to $1,770, that dip is the pullback you might want to buy, assuming 1770 area has support, maybe a prior high or a Fibonacci 50% retrace of the last swing. Patience is key. Don't jump in until price comes to your pre-marked area of interest. 4. Look for a price action buy, sell signal. Once price is in your desired zone, e.g., it pulled back near a support in an uptrend, watch for a price action confirmation signal that the pullback may be ending. This is where candlestick patterns come in. You are essentially reading the tape at the critical moment. Common signals to enter a long trade in an uptrend at support include a bullish engulfing candle, a hammer pin bar with a long lower wick, a morning star pattern, or even just a strong bullish full-body candle that breaks above the high of the last few candles. For a short trade in a downtrend at resistance, look for the opposite: a bearish engulfing, a shooting star, long upper wick, a bearish harami, or a strong bearish breakout candle. The key is that price action shows rejection of the level and a resumption of the trend. If the pullback keeps slicing through support resistance without any hesitation, do not jump in. There's no signal the trend is resuming yet. Imagine you're watching a stock in an uptrend that pulls back to a prior breakout level, now support. You then see a hammer candlestick form right at that level, and the next candle ticks above the hammer's high. That's a classic cue to consider a long entry. 5. Execute the entry. When your conditions are met, trend identified, pullback to support our resistance, confirmed by bullish, bearish price action signal, it's time to enter the trade. The usual technique is to place a buy order just above the high of the signal candle for a long trade to ensure the momentum has actually flipped up, or place a sell order just below the low of the signal candle for a short trade. Sometimes traders enter at market as soon as the signal candle closes in their favor, but placing an entry trigger a few pips beyond the candle can avoid getting in on a false signal, failed pattern. In either case, you now have a logical setup. The market structure suggests the trend may continue, the price is at a value area, and the candle pattern indicates a turn in the right direction. 6. Place a stop loss. Every trade needs a protective stop loss in case the market doesn't do what's expected. In price action trading, stops are often placed just beyond the recent swing point or pattern that invalidates the setup. For a long trade, a common rule is to put your stop loss a few pips below the swing low of the pullback, or below the low of the candlestick pattern signal, such as the hammer's wick. For a short trade, the stop would go a bit above the recent swing high or pattern's high. This way, if price reverses and breaks that extreme, it's a strong sign the setup failed. For instance, if your bullish hammer is negated by price dropping below its low, the bullish signal is broken. By placing the stop just beyond the level that should hold if you're right, you minimize risk and exit quickly if proved wrong. For example, if you bought after a hammer at support that had a low at $50, you might put your stop at $49 or $48.50. If price falls that far, clearly support didn't hold. Always determine your stop level before entering the trade so you can calculate proper position size and risk. More on that in risk management. 7. Set a profit target. Determine in advance where you'll take profits, or at least partial profits. Many price action traders use the next resistance level in an uptrend or the next support level in a downtrend as logical targets, since that's where the move might stall. Another approach is to aim for a risk-reward ratio, e.g., Target size equal to twice the stop distance for a 2.1 RR. You can also trail your stop loss behind higher lows in an uptrend or lower highs in a downtrend to ride a trend as far as possible. This way, you stay in until a reversal in structure stops you out. For simplicity, you might decide, I'll exit when price reaches the prior swing high on a long trade, or use a measured move projection, e.g., the height of a prior range added to the breakout point. Example, you bought at $51 with a stop at $49, risk 2. The recent swing high is $57. That could be a reasonable target, as price may retest that high. That offers a potential $6 reward for $2 risk, a nice 3.1 ratio. Adjust your target based on market conditions. If the trend is strong, you might aim higher. If momentum seems to wane, you can be more conservative. 8. Manage the trade. After entry, the trade needs to be managed. There are a few components here. 9. Trade management. If the trade moves in your favor, consider moving your stop loss to break even once price has made a significant move to eliminate risk. You might also scale out, take partial profits, at interim levels. If the trade immediately goes against you and hits your stop, accept the loss. It means the price action signal failed or market conditions changed. Don't revenge trade by jumping back in opposite. Instead, reassess calmly. 10. Price behavior. As the trade progresses, watch how price behaves at interim levels. For instance, if you went long and price is approaching a known minor resistance, does it blast through or start printing reversal candles? You could decide to lock in some profits if you see stalling. Price action trading encourages reading the market story bar by bar. 11. Exit strategy. Stick to your plan for exiting. If your target is reached, close the trade, or close most of it and trail the rest. If you're trailing stops, you might use price action clues to decide when to exit, e.g., a break of a trend line or a candlestick that closes beyond a moving average, if you allow one indicator, or simply the price making a lower low for a long trade, which breaks the sequence of highs and lows. By following these steps, you're systematically executing a price action strategy, aligning with the trend, buying dips, selling rallies at value areas, confirming with a price signal, and managing risk. It encapsulates the philosophy of trade what you see, not what you think. Price action will tell you when your trade thesis is likely correct, e.g., a strong impulse in your favor after entry, or when it's invalidated. Price hits your stop or prints an opposite signal. In the next section, we'll walk through an example trade to solidify this process. Let's put the strategy into practice with a concrete example. Suppose we have an uptrending market, higher highs and higher lows in place, that recently pulled back to a key support level. We will look for a bullish price action entry to ride the next move up. Refer to the chart below. Example: price action trade on an uptrend. The market is trending up. Note the higher highs and lows. It pulled back to a support zone and formed a bullish hammer. An entry, buy, is triggered as price breaks above the hammer's high. The stop loss is placed just below the swing low support, and the profit target is set near the next resistance level. In this example, the market had been in a healthy uptrend, but then it retraced down to a support area, perhaps a previous swing high, that now could act as support. Right at that support, we observe a bullish hammer candlestick with a long lower wick, indicating that price dipped and then buyers drove it back up, a sign that support is holding. According to our strategy, this is a prime setup to go long. Entry: we place a buy order slightly above the hammer's high. In the chart, the hammer's high was around $110. Blue arrow marks the approximate entry. When the very next candle rallied above that level, it triggered our entry at about $111. This confirms buyers are indeed taking control, as price pushed above the candle that showed rejection of support. Stop loss. The stop is positioned just below the hammer's low, the swing low of the pullback. That low was around $107, so we set the stop a little lower. Red dashed line around 106. This means if the trade doesn't work and price drops all the way back and breaks support, going below 107, we exit for a small loss. We risk, say, $5 per share on this trade, from $111 entry to $106 stop, hypothetically. Target. We identify the next major resistance or prior high as our profit target. In this case, the last swing high in the uptrend was around $119.120, which is a logical area where the price might face selling pressure again. We set our take profit near that zone, for example at $119, green dashed line. That gives an expected reward of roughly $8 per share, from $111 up to $119. Relative to our $5 risk, that's about a 1.6.1 reward to risk. One could aim a bit higher or lower depending on their risk appetite. As anticipated, the price indeed rises from our entry point, resumes the uptrend, and eventually reaches the resistance area around $119, where we exit with a solid profit. Outcome: this trade went according to plan. The uptrend resumed, making new highs, and hit our target. A trader might choose to take full profit at $119, or perhaps take partial profit and let the rest run in case the trend continues beyond $120, using a trailing stop to lock in gains. In this scenario, the risk was well contained by the stop below support, and the entry was only triggered after evidence of buyers stepping in, so the probability of success was higher. Not every trade will be this picture perfect, but by following the strategy criteria, you significantly improve the odds of catching a favorable move. A few lessons from this example. Always wait for confirmation, the break of the hammer high, rather than blindly catching a falling knife at support. Patience prevents many false start losses. Place stops where the trade idea is invalidated, below the key support in an uptrend trade, so you're out if the market truly reverses trend. Let the winners run to logical targets. In trending markets, setting a take profit near the prior major high, for longs, or low, for shorts, is a common and effective tactic. You can adjust if momentum is extremely strong or weak, but have a plan. By walking through such examples on historical charts, you can build confidence in reading price action in real time. It's highly recommended to practice spotting these setups and even replaying past chart data to simulate the decision process. Next, we'll touch on managing risk and other tips to keep in mind when trading price action. No trading strategy is complete without discussing risk management and some final best practices. Price action trading, like any approach, will have winning trades and losing trades. Managing your risk is absolutely crucial to long-term success. It ensures that no single trade or streak of trades can knock you out of the game. Here are some key principles and tips. Always use a stop loss. As demonstrated, always set a stop loss on every trade. This is your safety net. Even the best price action setup can fail due to unexpected news or simply a probability play not panning out. A stop loss keeps a small losing trade from turning into a disastrous one. Stick to the stop. Don't widen it hoping for a rebound. If price hits the stop, your trade thesis was wrong. Take the controlled loss and move on. Remember, maintaining strict discipline in risk management is as critical as ever, especially since trading without indicators means you rely on your read of the market, and no one is right 100% of the time. Position sizing. Determine your position size based on the distance to your stop and your risk per trade limit. For example, if you don't want to risk more than 1% of your account on a trade, and your stop is 50 pips away, calculate how many lots units you can trade so that 50 pips 1% of your account. This way, whether your stop is 20 pips or 100 pips, your dollar risk remains constant. This is a fundamental rule. Never risk too much on one trade. A common guideline is to risk only 1 to 2% of your capital per trade. Small, consistent risks allow you to weather losing streaks. Reward to risk ratio. Aim for trades with a favorable reward to risk ratio, RR, such as 2.1 or higher when possible. If you risk $100 to make $200, you can be profitable even if only cover 50% of your trades win. By contrast, if you routinely take 1.1 or lower RR, your win rate must be very high to compensate. Price action setups often allow for good RR because you enter near support, shock resistance with clear invalidation points and targets. Be selective, skip trades where the potential reward is very limited compared to the risk. It's better to wait for a setup where you can, say, risk 10 points for a realistic chance at 20-30 point gain. Avoid overtrading. One challenge in price action trading is the discretionary nature. You might see signals everywhere if you look hard enough. Stick to your strategy criteria. Not every candlestick wiggle is a trade. It's better to trade fewer, higher quality setups, e.g., a textbook pin bar at major support in a strong trend, than to jump at every minor pattern. Overtrading not only racks up transaction costs, but also often means taking subpar trades out of boredom or impatience. Have a trading plan and a checklist for your setup. If the situation doesn't tick all the boxes, trend, level, signal, then no trade. Adapt to market conditions. While we have focused on trending scenarios, be aware of broader conditions. If the market is very volatile, big news events, patterns can be less reliable. Perhaps use wider stops or stand aside until volatility normalizes. In prolonged low volatility ranges, you might tighten profit targets as moves won't run as far. Price action trading is as much art as science. It requires reading the context. Multiple time frame analysis can help. For instance, check a higher time frame chart to ensure your trade isn't running into a larger trend line or major level you hadn't noticed on your lower time frame. Keep a trading journal. Because price action trading can be subjective, it's invaluable to journal your trades. After each trade, win or loss, note what the setup was, how you managed it, and how the price behaved. Include screenshots of the chart. Over time, you will likely spot patterns in your own performance. Maybe you notice that evening star patterns at resistance yield better results for you than, say, trading breakouts of inside bars. Or you might find you get into trades too early before confirmation. A journal helps you continuously refine your skill at reading price action. It turns each trade into a learning opportunity. Developing skill and patience. Utilizing price action trading effectively requires skill and time to develop. At first, it might feel overwhelming. So many candles and levels to interpret. Start with one aspect at a time. Perhaps practice just identifying trends correctly. Then practice drawing SR levels. Then look at candlestick patterns in hindsight to see how often they worked at key levels. As you gain experience, you'll improve at quickly sizing up the market's condition and spotting actionable signals. Be patient with yourself and with the market. Some days will have no high probability setups, and that's okay. Avoid forcing trades. With enough practice, reading a naked chart will become second nature, and you'll develop an intuitive feel for when a pattern looks right. Avoid indicator temptation. Mostly. Since you've chosen a price action approach, try not to clutter your charts with indicators that might cloud your read. However, some price action traders do use a couple of simple tools as aids, not crutches. For example, some like a 20-period moving average just to judge average price or dynamic SR, or volume bars to see if a breakout is supported by high activity. These can complement price action analysis if used lightly. The key is that price is still the primary signal. Any indicator is secondary. If you find yourself ignoring the actual candlestick because an indicator says something else, you've defeated the purpose of price action trading. Always remember, indicators are derived from price. Price is the source. Continuous learning. Market conditions evolve. And there are always new subtleties to learn in price action. Study historical charts, especially of successful traders who explain their price action trades. There are many free resources and communities where charts are shared. Learn how different markets can have slightly different personalities, e.g., Forex pairs might respect technical levels very well, while individual stocks can be more erratic unless there's volume. As Bruce Lee might say if he were a trader, be like water. Adapt your price action strategy fluidly to the market in front of you, while adhering to its core principles. In conclusion, trading with price action is a powerful approach that empowers you to understand and trade what the market is doing right now, without lagging or conflicting signals. You've learned how to identify trends, draw support and resistance, recognize key candlestick patterns, and execute a strategy that capitalizes on these elements. By applying solid risk management and continuously practicing, you can simplify your trading and gain confidence in reading the market's story through price. Remember, the goal is to make trading decisions based on price and structure, the clearest representation of supply and demand at work. With time and experience, you'll start to anticipate moves just by watching price levels and price behavior, a skill that can serve you well across any market and time frame. Happy trading, and may the price be with you.